yes, we do own banks, and we are sort of cautious holders. I mean, the earnings season could be a bit problematic. Look for guidance. Maybe the absence of guidance could be a bit problematic. But sort of generally the picture is one of anticipation that these capital buffers should wear the banking sector through. But that capital buffers, of course, is where the securities, the losses, unrealised losses are hidden. So, look, I think the net position is that we're sort of cautious, sort of slightly underweight banks, but willing to hold them on cheapness. But actually what the tightening in bank lending standards that might sort of materialise may offer enough sort of headroom for, like, the Federal Reserve, if you like, and other central banks not to go quite so high on interest rates, which, you know, might be and has been like a relatively good news story for equity markets at large. But banks sort of cautious to underweight, but well worth holding some.
As you think about the space, though, I mean, is there a geographical focus, or is there a best in breed based on which sectors of the economy the banks are focused on? Wholesale or investment Vs, deposit taking? I mean, how do you be more specific for us?
Okay. Well, I think in our preference would be for the European banking sector over the US. I think the way in which the Federal Reserve will execute policy would be a little more forgiving and therefore wouldn't allow the anticipation of what you can make out of loans is going to come under a bit more pressure. So I think Europe is going to be a slightly higher for longer interest rate story, which is better for net interest margins there. Slightly more orthodox lending, I think, than what's happening in the US as well. So on balance, probably just favouring Europe over the US within the financial sector.
On your bond exposure, you're suggesting taking more duration. Why would you do that at this point, given the outlook is so cloudy and you can be rewarded for just very short-term exposures to the bond market as well?
Yeah, I think, you know, I think all moves seem to have an air of controversy around it at the moment because everything's sort of so uncertain, but that reflects in part a modest overweight to equities. For some of the reasons I've mentioned, I think, like the inflationary pressures maybe continue to abate, perhaps not at the pace that we want, should allow central banks to sort of take, or certainly the Federal Reserve to take a pause sometime soon, and that can continue to support equity markets. But if, as a result of, like, the banking stresses and the speed at which they're sort of tightening lending leads to a more pronounced downturn, then that overweight equities position isn't going to be particularly helpful. Therefore, in the bond portfolio, you know, you want some hedges against that. So it's not necessarily like a big call on duration. It's something of a hedge against a favoured leaning towards equities in a balanced portfolio.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.